usually, right?
Yes, there's a drop-off rate. Okay, so welcome Columbia Angels and friends. Roar Lions Roar. Tonight, we have the honor to receive our very popular Columbia Business School professor, Angela Lee. This will be our third Angels event. For our kickoff event, we had Paulo Passoni from SoftBank, followed by an event last month with Andre Dalmeida Monteiro from Xispe. The links to those recordings are posted on our social media pages, LinkedIn, Instagram, and Facebook, as well as on our site. This event will be recorded as well. Our site is saopaulo.alumni.columbia.edu. You can easily find the links to our site and social media pages on the lower section of all of our emails. Follow us and like our pages. We post our future events there as well. Now that we're talking about future events, invites are already out for our virtual wine tasting happy hour on the 24th of August. We'll have lots of fun learning about the recent evolution of the Brazilian wine industry. You can order your wines up until August 10th, but there is no need to purchase the wines. You are welcome to join us for free with your own wine, caipirinha, Coca-Cola, or drink of your choice. Don't miss it. It's an opportunity to mingle and interact. On September 14th, we'll have CIPA professor and Harvard scholar, Rodrigo Suarez with us, who's a reference when it comes to health economy, world health economy. We'll be discussing the economic aspect of the pandemic. After that, on November 9th, we'll be hearing from Cintia Andrieta, our Columbia colleague, who is in charge of the legal sector of Natura. Her colleague from the operations area will be joining us too. These are confirmed events, by the way, and there are others that are being organized and will take place in between. On November 23rd, answering to popular demand, we will have Ronaldo Lemos with us, a specialist in cryptocurrency. And now this is very important. We just sent out a survey and posted it on our networking chat as well. We have an excellent group of volunteers working to run our association, but as they say, it takes a village. It's up to each and every one of us to make our association strong by being active, taking part in events, and by helping us out by answering our survey. We'd like to hear your opinions and suggestions and give you a chance to volunteer too. We also have great news. We now have the date for our first Columbia Angels Alumni Brazil Angels Pitch Night, which will be on August 31st. I'll let our Angels leader, Harry Chan, tell you more about that. Thank you, Professor Angela Lee, for being with us once again this afternoon, although virtually. Harry will tell us more about the Columbia Alumni Angels Brazil Initiative. Harry?
Thank you, Diana. Welcome, Professor Angela Lee. Great to listen to you. I think we have a very eager members here in the Columbia Angels group wanting to learn from you so that we will take our first steps. For those of you who are participating today who are not part of the Columbia Angels group, you're all welcome. Our philosophy is open doors and open arms. And please come and join us. We have lots of exciting things going on. We have lots of startups now. The deal flow is starting. It was founded at the end of May this year. And now our first pitch night will be 31st of August. And hopefully you will all be able to take part. Besides that, we will have other activities beyond the ones that Diana mentioned with Thomas Silva from Goldman Sachs, who is the head of Fininvest in Brazil, who will be talking with us. We'll be having also Itaú BBA's managing director, who will be joining us for another event. So there are all sorts of things going on. Very exciting times. And now we need to all learn about how to invest with angels from Angela Lee so that we will make safe investments and hopefully one of us will hit a unicorn. Now, Pedro is the head of the Columbia Business School Alumni Association, and he is also a member of the board of the Columbia Alumni Association here. And I would like to ask Pedro to be the host of this meeting. Pedro.
Thank you, Harry. Quick introduction on Professor Angela Lee. First of all, thank you, Angela Lee. You know, it's a great honor. So Angela is a professor of practice and also the Chief Innovation Officer at Columbia Business School with more than 20 years of innovation strategy and entrepreneurship experience. She teaches the courses of venture capital and leadership. She started her career in product management and then moving to strategy consulting at McKinsey. She's passionate about entrepreneurship and has started several companies in the education sector. She's a startup investor and the founder of 37 Angels, an investing network that has evaluated 15,000 startups, invested in 60 of them, and activates new investors through a startup investment bootcamp. You know, Angela has spoken at the White House, NASA, and is a sought-after expert on CNBC, Bloomberg TV, MSNBC, and Fox Business. She was recognized by Inc. magazine as one of the 17 inspiring women to watch in 2017, by Entrepreneur magazine as one of 6 innovative women to watch in 2015, and by Crain's as a notable woman in tech in 2019. Angela, she received her BA from the University of California, Berkeley, and her MBA from Columbia Business School. Well, without further ado, the floor is yours, Professor Angela Lee.
Thank you so much. It's good to see so much interest in this topic, and I'm super bummed that I'm not there in person, and I'm also bummed that I don't get to participate in the wine night. For 37 Angels, our holiday party last year, we did a virtual wine tasting, which I hosted, which was interesting and fun, and I love how we're learning how to socialize in this new and interesting way. And another fun fact is my last international trip before everything went a little bit nuts is I was in Sao Paulo in December of 2019, and raise your hand using the Zoom function if you were there, just as I'm curious. So there were probably like 25 people there. I think like a dozen were from the Columbia Alumni Association, and then maybe a dozen were from Poly Angels in Sao Paulo. But I'm not seeing any hands, but definitely met some folks there in person, and so hope to visit again one day.
I was there.
Oh, good, yes. Good to see you. Awesome. So thank you for the lovely introduction. And I thought today what I would do is just try to answer 3 questions. And the 3 questions I wanted to answer are, you know, what is it that investors look for in diligence? What are trends in the ecosystem? And then what to answer for yourself before starting to invest. I'm happy to take questions at the end. And I'm also happy to talk about what Columbia Business School is doing right now. I teach venture capital courses, but I'm also the faculty director for the Lang Center for Entrepreneurship. So we've got lots of really cool and exciting things happening at the business school. And I don't know when folks graduated, but when I graduated, we were moving into the business school and like very soon. We are moving into the new business school in January 2022. So it is happening. We're going to be on the new campus. With that, let me kick us off. So this is what I want to go over. Now, I'm going to do some kind of very basic lay of the land. I'm assuming that a lot of folks this is going to be kind of review, but I think it's just always good to level set so that we are all speaking the same language. So I just want to make sure everyone knows the difference between venture capital and angel investing. Again, sorry if this is too basic, but the way venture capital works is you have a general partner and he or she raises money from a bunch of limited partners. And so if all of you gave me $2 million to invest, I would have a $100 million fund. I'm the general partner. I make investment decisions on your behalf. So the decision-making is made by the general partner. Angel investing, contrastingly, the decision-making is really made at the individual level. And so I think that's a primary difference. It tends to mean that VCs have larger check sizes that they can invest in. It tends to mean that angel investing, there's a little bit more cat herding, but we have a lot more flexibility on what we invest in because we don't have fiduciary responsibility to our LPs. We're investing our own capital. Financially, what that means is that VCs are taking fees and carry, usually 2% on assets under management and 20% carry, 20% on whatever they make. And then angel investors, we tend to pay dues into an angel network. So again, assuming folks know that. And then something that I always recommend that people do as they're starting to angel invest is to just make sure you have relationships with everyone in the ecosystem, because startup investing is very much a network-driven business, and you are only as good of an investor as your network is strong. So I am primarily a seed investor. both at 37 Angels and at the fund that I'm a venture partner in. And so because I'm a seed investor, I know pre-seed investors and I know Series A investors. The pre-seed investors are going to send me great deal flow, and then I'm able to help my companies fundraise for Series A. We're partnering with accelerators so that we're getting early looks at their best companies. And so we kind of get that inside track. Service providers are actually really useful. So law firms, CFO outsourcing companies, payroll companies, they often kind of know the nitty gritty and are really great sources of deal flow. Obviously, universities are a great source of deal flow. Also, governments, right? Different governments have really partnered to be more startup friendly or not startup friendly. So like, I love investing in Canadian startups, for example, because their government has created a lot of tax incentives where they'll match funding and do really great things for the founders. And they've created a very startup friendly ecosystem. And then corporates, because we want to form strategic partnerships and we want the corporations to be acquiring the companies that we invest in. So I just strongly encourage you to look at your network and ask yourself, where do I have a rich network? Where do I have gaps? And actively start to build out that network, because the more you can support your portfolio, the better of an investor you will be. Speaking of deal sourcing, there are a couple of different ways to source deal flow. There's kind of unreferred and referred deal flow. There are lots of ways to get unreferred deal flow. The two probably most famous ones are Gust and AngelList, and obviously for all of you, the Columbia Angel Network. I'm sorry, that would be on the referred deal flow side. But on the unreferred side, if you were to go onto Gust today and put your name on there, you're going to start getting a bunch of unreferred deal flow. If you can sign up for AngelList, is like LinkedIn for angel investors, and you can sign up today and you're going to start getting deal flow. If you just put angel investor on your LinkedIn profile, people are going to start direct messaging you, and so you will get tons and tons of unreferred deal flow. Not surprisingly, the quality is better when the deals are referred in from people that you know. To give you a sense, every year we look at about 2,500 companies, and our deal flow is probably 50-50 in terms of unreferred and referred. We've invested in 80 companies to date, and I think 68 of them were referred in. So even though from a volume perspective, we're seeing kind of relatively similar volumes on two sides, the quality is much better from referred. And we're going to take a little bit of a closer look if somebody we really trust is referring the deal. Just to give you a sense of what our kind of process looks like in a year, we will look at 2,500 companies. We roughly meet with 1 in 4. And that's not true for every network. So Greycroft, for example, a very well-known firm here in New York City where I'm based, they look at about 3,000 companies and they meet with about every other one of them. And so it is very different depending on the size of the firm, as there's different ratios. We will then curate the best ones to pitch to our angels. Our angels then write diligence memos, and we roughly invest in 10 per year. So we've been in business for about 8 years, and so we have 80 portfolio companies. And I think it's important to just understand that process and to understand kind of what people are looking for at each stage of the game. Speaking of which, what do we look for? So I really like alliteration, so I like to break things into the 4 Ps. And so when we're looking at a company, we look at the people behind it. So do they have relevant domain expertise? Do they have a complementary team where the roles and the backgrounds make sense and complement each other? And there's this like magical thing of it factor, right? Which is when you look at that founder, if it's a good idea, you've probably heard that idea 10 other times that year. And so I have to look that founder in the eye and really believe that they're going to beat the 10 other founders that have pitched me the exact same idea. So that's people. Then it's problem. Is it a large problem that they're solving? What does the competitive landscape look like? Do they truly understand the problem they're solving for customers? Then progress, right? We want them to have some degree of traction. To give you kind of some high-level guidelines, right now, seed investing is probably 80 to 90% post-revenue. The idea of investing on an idea in the back of a napkin isn't really happening in seed anymore. First of all, what's seed? In New York City, a seed round is raising between $1 and 2 million at between like a $6 and $10 million valuation. In San Francisco, it's raising between 1 and 3 million at probably a $7 to $12 million valuation. In Sao Paulo, I tried to look at this actually this morning, right? Maybe a little bit 2 years ago when I was there, it might be raising kind of 1.5, maybe at like a $5 to $7 million valuation. You know, you would know better than I would, but it very much depends on the ecosystem where you are. But pretty much around the world, seed tends to mean post-revenue. Pre-seed often means pre-revenue, kind of you have a minimum viable product, you have a prototype. People tend to raise a Series A when they have $1 million in recurring revenue. That's a very common milestone to hit. So you want to have progress. And then the really important thing around progress is repeatable progress. I would much rather a company come to me where they have very little progress, but they know exactly how they got it. They're like, we know that we got, 150 customers from Facebook ads, and we know we got, 250 customers from direct email, and we know that we got this many customers from Instagram ads. And I know my customer acquisition cost. I'm going to go through this a little bit more in a couple of slides. And then of course, price. We need the valuations to be fair. We need the terms to be fair. Yes, if folks have questions, feel free to throw them into the chat window. So let's share a couple of examples, and I'm, again, happy to answer questions at the end about any of this. So in terms of people, we are looking for relevant domain expertise. So this is an excerpt from a real startup pitch deck that, we got sent to us, and there's nothing wrong with this team description, right? This person has, 15 years of experience, they've worked in competitive industries, fast-paced environments, strong, impressive track record. If you read this and you were to ask yourself, what is this person uniquely qualified to do? I would argue I don't really know. Like, what type of startup is this person uniquely qualified to do? I would argue I really don't know. So we see this a lot where we have a team slide, you've got all this really impressive stuff. They worked at these great companies and they've done all this great stuff, but is their background relevant to the startup that they're starting now? That is much more important in B2B than B2C. So if it's a direct consumer company and they're starting a cookie company or something that's a little bit more like layperson understandable, domain experience is less relevant. But for B2B, especially if it involves enterprise sales and it's a complicated environment, domain experience has shown to be more directly correlated with success. So, and that's because you obviously have the Rolodex where you can then go and talk to clients. You also have credibility when you're selling into organizations, and so we really look for domain expertise. We also always ask the question, who is your next hire? So we will look at their current team. So usually for seed investing, the teams that we look at will be 2 to 3 person co-founding team, and they'll have between 1 and 10 employees. That's kind of the range size of company that I look at. And I'll always ask them, who is your next intended hire? So we just looked at a company that does B2B underwriting support for companies. So think of it like a credit score for B2B underwriting to help lenders decide what's the credit worthiness of this other company. And the founder was a data scientist, which makes sense because this is a data science company, and they'd hired 7 data scientists to work with them. And I said, who's your next hire? They said, the next hire is a data architect. And when I see that, it tells me that they don't really necessarily know what is needed to build this company out. I would have loved to hear that our 4th hire was a salesperson, for example. So we're looking for people who deeply understand what is needed to build the startup. So I see a question here, which is regarding the price. Does the current low valuation of Brazilian, yes and no. In terms of cross-border investments, the data shows that for angel investors, 90% of angel investors invest in their backyard. So angel investors are not thinking as much about price arbitrage and all that kind of stuff. The other thing is we tend to invest because we're better. So if you think about what an investor does, we source deal flow, we select great companies, and then we support them through exit. It's harder to source deal flow and support companies when you're not from that local geography. So for all those reasons, angels tend to invest in their own backyard. Now VCs will have a more sophisticated geographical strategy where they're thinking about things like that. But I would say for most angels, they're going to invest in their backyard. Okay, in terms of problem, what we're looking at is a really large problem. So we see a lot of slides that look like this. Our market is $5.6 billion. I've never seen a market slide from a founder that didn't start with a B. It's always billions and billions and billions of dollars. So our job as investors is to look at a slide like this and to say, well, what truly is the addressable market for this company and what is obtainable by this startup? So we're going to ask questions about who their customer is. So this was a company we looked at that did dermatology through telemedicine. So, you could look at somebody over Zoom and tell them, if they have a sunspot or if they have melanoma. You can also help with, acne prescription, and you can diagnose people over the phone, which is great. And what they're saying is that there's this many women in the U.S. They're spending more on healthcare than men, so this is the market. Now, these are true statements. However, does that really tell you how much money this startup can make? It doesn't. So our job as investors is to do both a top-down analysis and a bottom-up analysis of the market size. A top-down market looks like this. And then I would say, okay, well, what percentage of American women are seeing dermatologists in a year? Okay, so then let's say it's 20%. So 5.6 gets multiplied by 20%. Okay, well then, what percentage of people are comfortable with telemedicine? Maybe it's 50%, especially in a post-COVID world, right? Probably a pretty high percentage. Okay, so I'm gonna multiply them by 50%. And you keep cutting it down until you really get a sense of what is truly the market that is addressable by your product or service. That's a top-down market sizing. And then a bottom-up market sizing would be, this startup did a pilot in Tallahassee, Tennessee, and New York City. And here's what they found. This is how many appointments they made. This is how much money they made in 6 months. And then what you could say is, well, how many markets look like Tallahassee, Tennessee, and look like New York City? And then I can multiply it up and say, okay, if you made $100,000 in those markets, there are 50 markets that look like this, so you can make this much in a year. So that's a bottom up, is taking their data and extrapolating it up. And in an ideal world, you can do both as you're analyzing a company. Now, a lot of angels, you'll hear a very common threshold say that we won't invest unless we believe the market size is at least $25 million, meaning we believe they can make $25 million per year. And we assume that they can only capture between 5 and 10% of the market. So that means they have to be playing in a $250 million to $500 million market. So we have to believe that the addressable market is between $250 million and $500 million, so that the startup, by capturing between 5 and 10%, can make $25 million a year. So our job as investors is to say, is this market large enough to really support that? That's a problem. And people get very aggressive about their market size. This is a company that pitched us. They do innovation assessment testing of employees. So people really care about their employees being creative and innovative these days. It's a very important skill set. And so it's a test that a hiring manager can buy and give to 10 candidates and say, how innovative, how creative are you? And the pitch deck had this: the Global Innovation 1000 spent $680 billion in 2015, and people really care about innovation. Look at all these conferences. Again, this doesn't tell me anything about how much money they can make, right? The Global Innovation 1000 spent $680 billion. I don't know what that means. But if you could tell me how much is spent on HR assessment software every year, that starts to give me a sense of the market size. So we're looking for realistic market sizing. In terms of progress, by the time a founder is pitching a seed investor, they should be able to create a slide that looks like this. Mr. and Mrs. Investor, we tested direct mail, tabling, blogs, search engine optimization. You know what works the best for us? Direct email. When I email 10,000 people, 500 open the email, 100 click on the shiny green button, and I get 10 customers. And now, as a founder, you can calculate the golden ratio of CAC to LTV, customer acquisition cost to customer lifetime value. So I would argue, again, to pitch a seed investor these days, you have to know those numbers. How much does it cost you to acquire a customer, and then how much they spend with you over the life of their relationship with you? And it has to be a minimum of a 3-to-1 ratio. So your customer lifetime value has to be at least 3 times your customer acquisition cost. And so the founder has to say, you know, when I got those 10 customers, I had to pay this much for the email list. I had to pay this much for a marketing copywriter. I had to pay this much to use MailChimp or, you know, whatever email software you're using. Okay, it cost me $25 to acquire each of those customers. Well, then those customers have to spend at least $75 with you. Otherwise, the math doesn't work. We want them to run some experiments, what subject lines work better, what time of the day is best to email people, and then do they understand their customers? Typically in 3 ways. What are the customer demographics? What are the customer psychographics? And then what is the problem you're solving for the customer? Demographics, we all understand: age, income, education level, where they live. Psychographics is personality, lifestyle choices. You know, do they eat organic? Do they shop at like the fancy local organic grocer, or do they shop at more of kind of like a big box store? You know, like politically, where do they lean? All that kind of stuff. It's really like that customer persona that you really want to understand. And then finally, what is the problem you're solving for the customer? For those of you who are less familiar with customer acquisition channels, I really recommend this book. It's Traction by Gabriel Weinberg. And by the way, there are several books called Traction, so definitely read the one by Gabriel Weinberg. And he walks through the 19 different customer acquisition channels. It's a great book to read as an angel investor. It's also a great book to read if you're advising founders, because they might say, I don't know how to do search engine optimization. I don't know how to make my, you know, search come up high in Google. Tell them to read this book. So that is what folks look for in the ecosystem. And so I'm going to answer some of the questions in the chat window, and then we'll kind of continue to go. So is the CAC to LTV ratio of 1 to 3 in terms of revenue or marginal profit? Great question. Revenue. So it is top line revenue versus marginal customer acquisition cost. And the higher, the better. So if it's a 5-to-1 ratio, even better. You obviously want your customer lifetime value to be high and your customer acquisition cost to be low. Okay, let's talk about a couple of overall trends, actually. Oh, this is a very long question. So the economics between angels and LP and general partners, is the GP charge 2 and 20? Yes. 2 and 20 is typical. For those of you who come from the private equity or hedge fund world, you'll often see funds have a hurdle rate. A hurdle rate means that until they make more than X, you don't get any money back. You'll often see 2, 20, 20. VC funds often don't have a hurdle. It's just 2 and 20. Do the angels LPs require the GP to provide a clawback provision on the carried interest to compensate for the losses taken into the fund? No. So there are 2 types of distributions to an LP. There's a European waterfall and an American waterfall. And like everything else, the American waterfall is more beneficial to the GP. And so it's not a clawback, it's a waterfall system. If you want to read about European or American waterfall, you can certainly do that. Actually, I'm about to give you a really depressing statistic. So I'll show, this is the first, I'm showing some depressing slides now. This is venture capital fund ROI. So there are 2 metrics that venture capital funds are measured on. The first is multiple, right? Which is, you give me $1 million, I give you 3 million back. That's a 3x multiple. And every early stage venture capital fund is targeting a 3x multiple. The LP gives them $1 million, they return $3 million in 10 years, because venture capital funds tend to be 10 years long. If you look at this very depressing pie chart, half of VCs are not even returning the LP's capital. So the LP gives them $1 million and they return $750 10 years later. Not good. I mean, you can see the chart. So the target is basically the green and the yellow, but the vast majority of funds are not meeting those targets. The other metric is internal rate of return. And the way that you track internal rate of return is, again, I'm assuming you all know how to calculate IRR, but it's calculated on a 10-year fund life cycle, because VC funds are 10 years. And so the way that you read this chart is by vintage year. So in 1999, funds that started that year went from 1999 to 2009. They didn't perform very well, as you can imagine. But if you started a fund in 1995, And then it went to 2005, you tended to perform pretty well. Unfortunately, over time, the venture capital asset class has actually basically mildly outperformed the S&P 500, which doesn't make any sense because venture capitalists are taking on way more risk to basically do the same returns as the S&P 500. And so it's the people who are making outsized returns that are bringing up that average, but this is a depressing chart. Would you expect the CAC to LTV ratio to already be 1 to 3 at the angel stage, or a projection of it? How flexible to see this measure? At seed stage, yes. If you're a seed investor, this slide is pretty much already baked with a 3 to 1 CAC. If you're a pre-seed investor, that's less true, right? Pre-seed, they might have a prototype and a few beta customers, and they're still figuring all this stuff out. But as a seed investor, raising kind of like a professional round of capital, which again, in the US is between 1 and 3 million, I would expect to see this. Is it common to audit the CAC to LTV metric? I found that what goes into CAC, absolutely. So we're gonna ask questions. So what are you putting into customer acquisition cost? And they might say, my CAC is free because I wrote the emails myself and I emailed my 100 best friends. That is not a repeatable customer acquisition cost. So we're looking for a repeatable customer acquisition cost. We're looking for reasonable assumptions. So we absolutely do audit that. And then same on customer lifetime value, right? So if it's a retail company, what's your average order value? What's your return rate? What's your repeat purchase rate? And what you can tell very quickly is if they can't answer those 3 questions, they've kind of made up their LTV. So by asking 2 or 3 questions to dig into how they calculated their customer acquisition cost and their customer lifetime value, you can very quickly see if there's a there or not. I realize I'm talking very quickly. I'm going to try to slow it down a little bit. This is a fun chart. So this is showing that the number of VC funds keeps increasing. So this is in the US. Other than in 2020, we've had between 600 and 1,000 new venture capital funds started each year. That is an absurd number of new funds. So for those of you who've been following the market for a while, venture capital valuations have been rising. Why is that? It's because there's a lot of money chasing the same number of deals. And so you have to be very disciplined as an angel investor because there's so much out there right now. But to get into the best deals and to pay attractive valuations takes some discipline. So I think this is just a really interesting chart. And then I would be remiss in 2021 if I didn't talk a little bit about bias. And so as you are talking to founders, make sure to check your own bias. So research that came out of Columbia Business School that I'm assuming some of you have heard before is that when investors ask questions to male founders, they ask them promotion-based questions. How are you going to become the next unicorn? When investors ask female founders questions, they ask them prevention-based questions. How are you going to prevent Google from stealing all of your market share? So as investors, it's important as we're doing diligence, as we're hearing pitches and doing Q&A, that we are trying to ask the same types of questions to founders of different genders, different races, different sexual orientation. And for those of you who are advising founders and you're advising a female founder or a founder of color, when an investor asks them a prevention-based question, have them answer it, but then also have them answer the promotion-based question they didn't get asked. Okay, I'm gonna wrap this up with a couple of questions to answer before you start to invest, and then do want to open it up for Q&A. So as you are starting to invest, questions to ask yourself. So one is, how much control do you want over your investing? So obviously you're all part of a network, but just to recognize that there's kind of a spectrum of control. The most control is a solo angel. So I started angel investing in 2008. Fantastic year to start angel investing. And so from 2008 to about 2012, I was a solo angel. I would look at maybe 100 deals a year, and I would independently decide what I wanted to invest in. Ton of control, very little knowledge from my network, and very little diversification. An angel network, again, you all are familiar with this. There's usually kind of a governing body looking at some number of companies, you see some curated deal flow, but you tend to have a decent amount of autonomy over what you invest in. Contrasted with an angel fund. An angel fund would be, 50 people pool their capital into a fund, and in order for the fund to invest, some percentage of people have to vote yes. Now, the benefit and you can also be an LP in a VC fund. So I personally am invested in, I think, like 30 companies, and I'm also an LP in 4 funds. And so you don't have to pick one or the other. So the trade-off between these two sides of the spectrum is control versus diversification, and then time. Those are kind of the different parameters you're thinking about. So on the right, you have a lot more control. It takes a lot more time, less diversification. On the left, you have more diversification. It can be not time intensive at all, right? Because you can just give your money to a GP to manage, but you also have much less control over what your money is invested in. Make sure you know the risks. We've talked about the rewards, right? So the goal is 20% internal rate of return, 3 times your money in 10 years. That is the goal. Obviously, it's a phenomenal network to be a part of. You get to learn, it's fun. A lot of us have been founders. We get to mentor. There's like a ton of upside of being a startup investor. But as you saw, there's a lot of financial risk. It's illiquid. Right now, from seed to exit on average is 8 years trending upwards. And so don't put in money that you need in 2 years to buy a house or to pay for someone's college education. It's pretty illiquid, and you want it to be tied up. There are secondary markets emerging, but they're still emerging and new. Not very diversified, right? You tend to have to write larger checks to be an angel investor. And so it's not like, investing in the stock market. Angel investors, we're not going to have control, right? We're probably at most going to own 1% of the company. And so we are usually going to get dragged along with whatever the major investors want. And so it's really hard for us to control over what the company does. And again, for those of you who've been doing this for a while, it's emotional, right? It's different than investing in the public markets. And so it's something to be aware of. I would ask yourself where you want to focus, right? So what stage is interesting to you, sector? Is there a type of founder you want to support? Do you only want to invest in Brazil? Do you want to invest more broadly, and to think about that? Please, please, please diversify. So I would not do angel investing unless you are prepared to write at least 10 checks. Now, you don't have to do that in 1 year. I think a good cadence is maybe 2 to 3 checks per year, but do commit. The data shows very clearly that as you invest in more companies, returns increase. So you do need to diversify. Please don't invest in one company and run away. So I would say minimum of 10 checks. If that feels too expensive at the angel level, you could certainly do equity crowdfunding. There are hundreds of equity crowdfunding sites where you can invest $1,000 in a company, or Republic allows you to invest $50 per company. You can invest in accelerators, or you can invest in funds, which we've talked about. We have a ton of resources on our website. We have an event newsletter. We have tools for founders. We have accelerators. We have resources for female founders, blogs, and a glossary if you ever want to know about a term. I'm going to make a quick plug for a program at Columbia Business School called the Columbia Alumni Virtual Accelerator. It's for CBS alumni, where we pick usually a cohort of about 10, and it's a virtual accelerator, but we don't take any fee. But we've had some really successful companies. Also, for the first time, the Lang Fund is funding alumni companies. And so there's still a lot of cool stuff happening at Lang. If you have companies that you're working with who are interested in being in a free accelerator alongside other CBS companies, tell them to apply to our thing. This is the last class, and some nice words about us. I realize that I just talked incredibly quickly, and so I'm happy to take questions in maybe like the 10 minutes or so that we have left. And I will also pull this bit.ly and I will pull it into the cohort. I'll also mention, for those of you who want to learn more about this, I teach a course in executive education about venture capital. Let me link that as well so you have it if you want to learn more about that. Okay, with that, let me take questions. Yeah, any questions from folks? I can talk about angel investing. I can talk about venture capital investing. I can talk about Columbia.
Well, thank you, Angela. Fantastic presentation. I can get started here following your 4P process. and start with people. And I know this is very important, as you mentioned. It's probably the most important aspect. But how do you think about, the founders or the entrepreneurs having had previous experiences, founding companies or not? Is that a thing to be worried about, or do you prefer one or another? How would you go about that?
Yeah. So the data shows that a first-time founder and a previously failed founder are equally likely to be successful. So we do not penalize a founder for being previously unsuccessful, so long as they're not defensive and weird about it. In fact, it could be a positive thing. So we are invested in a company called Slate. They basically make social media branding very easy for companies. And so their clients are the National Football League, Fashion Week, Shiseido, places like that. Their previous startup was called Fontmoji, which allowed you to turn your handwriting into a font. Nobody wanted to pay for that. But that technology made them a year and a half ahead, and they're doing incredibly well right now. And the entire team stayed together through a failed startup and pivoted into this new thing. And so that was great. First Round Capital, which is a very well-known firm out in San Francisco, very successful. They did an analysis on their first decade of investing. And what they found is that previously successful founders are much more likely to be successful because you know how to fundraise, you have relationships with VCs and acquirers and a team. However, their fund did not make any additional money on them. Why? Because if it's a first-time founder, maybe you invested a $5 million valuation, they get acquired for $50 million. You make 10 extra money. The previously successful founder, they might exit for $150 million, but you invested a $15 million valuation. So you also still only make 10x. So what they found is that VCs love investing in serial entrepreneurs that have been really, really successful, but they don't make any more money on them because we're all bidding for each other. The valuation brackets up. And I love that analysis is because I'm also hoping it breaks some of those bias cycles, right? Because a lot of serial entrepreneurs are not as diverse of a founder background. And so I'm glad to see the data supporting us investing in first-time founders, and we absolutely invest in first-time founders. How do you feel about leverage on VC? I don't entirely know what that question means. If it's about venture debt, I can talk about that, but I don't entirely know what I mean by leverage. And so if you could clarify, that would be great. My take on the recent surge of micro VCs is that there are way too many micro VCs in the ecosystem. I think that there needs to be some consolidation in venture, especially in seed and pre-seed. And literally, I get sent a new VC pitch deck once a week, which is just way too many. So I'm very concerned. A very concerning statistic is that a decade ago, if you raised a seed or a Series A round, you would have about a 1 in 3 likelihood of raising your next round. So if you raised a seed or pre-seed round, you would have a 1 in 3 chance of raising a Series A. Today, if you raise a seed or a pre-seed round, you have like a 1 in 10 chance of raising your next round. There's so much money in seed and pre-seed that it's creating a lot of false positives of companies that never should have been funded. And I just put the link for the traction book into the window.
I have another question regarding people.
Great.
And how do you think about diversity of backgrounds and in the founders and also what do you absolutely want to avoid? Like from all the 15,000 startups that you looked at and the ones that failed, what do you look for to absolutely avoid?
So I think the number one thing we would avoid is like lack of coachability, defensiveness, infighting amongst the founders. It tends to be like the soft stuff that is an absolute avoid. We looked at a company that was a husband-wife duo, and every time the wife wanted to say something, she would look to the husband for approval and he would give a little nod. We didn't invest in that company. We passed in a company where the founder equity split was 85-15-5. And we felt that the 85% person was taking advantage of the 5% person, and they were really upset about it. And so we're like, this team's going to implode because people are kind of taking advantage of people. And so obviously ethical issues. So it tends to be the soft stuff that for us are the really big red flags. We recently had an ethical issue where a founder basically, misrepresented some facts that were incredibly easy to find that they were misrepresenting themselves. And so we passed very quickly. So ethical stuff, founder, weird dynamics, those are the big red flags.
Okay.
There's a question here about venture debt. And I just want to let people know that venture debt tends to happen alongside venture capital, where they loan them money. And what's interesting is that the statistics around venture debt is that the default rate is only 1 to 10%. So I actually think venture debt has a pretty good risk to return profile. At least that's what the data says. And the standard deviation of risk is lower. I shouldn't say the standard deviation of risk. The standard deviation of returns is lower than in venture capital. So you could argue that, actually not you could argue, I would say that venture debt is lower risk than venture capital. Sorry, Pedro, go ahead.
I think Harry had a question.
Oh, yeah. Thank you, Pedro. Angela, what would you look in a startup that would allow you to put a higher valuation in a company, that you feel that a company deserves a higher valuation?
Yeah, so I would say, like, for me, people and problem are the most important thing. So if it's a really strong team in a really attractive market, we are absolutely going to bump that up a little bit higher. And there are 3 things that we look for in an attractive market. One is network effects. So network effects are, by the person using the product, they're basically selling it for you. So for those of you who ever use paperless post or Evite, if I invite 30 people to my birthday party, those 30 people can now become paperless post or Evite customers. Those are network effects. If you want to read about network effects, Union Square Ventures, their entire investment thesis was on that, and they wrote about it. The second thing is switching costs. So if the business model has really high switching costs built in, that's fantastic. And then the last thing is recurring revenue. So those 3 things combined are going to lead to a higher valuation.
Great.
Do a follow-up on valuation. I received a question here. I know it's very tough to come up with a calculation for these early stage companies, and it's more art than science, and then obviously dependent on each business, on each industry, the cycle, the current cycle of the company, the financial situation. But do you have like a back of the envelope way to do valuations for these companies? How would you think about this?
Yeah, so for those of you who want to do a little bit of homework, you can Google the Berkus scorecard method, the risk factor summation method, and the VC method. And I actually think I have an article bookmark where you can actually read about them. There we go, this one. So this is a pretty good overview of valuation. You basically look at the different components and add or subtract value for what's good and what's bad. I don't really have a 2-minute answer. It's like an hour-long answer, but I'd say read that article is a good place to start.
Okay. And how would you think about financing rounds? Do you have to worry about this at this stage? Do you have to worry about their next step? Do you have to worry that they know what to do next? It's very early.
Yeah, I'm comfortable with a kind of 2-year roadmap. I don't expect them to know what's going to happen after 2 years, because I think that's kind of unrealistic and they're just making stuff up anyway. But I want a pretty clear funding pathway for the next 2 years, a hiring plan for the next 2 years, and a product development roadmap for the next 2 years in a pretty clear and articulate way. And I do find that a lot of founders massively underestimate how much it's going to cost to hire and how much it's going to cost to build the product. So we kind of compare those 3 things, make sure that makes sense, and that they're raising enough capital so that they can get to their Series A. And usually companies raise every 18 months.
Okay, we received some other questions here. Professors and investors, how would you identify the strong team element in an early stage of a company?
Data-driven learner, high empathy, high hustle, domain expertise, complementary skill set. And I actually like Ian Sigalo from Greycroft. He asks himself, would he work for that person? I really like that as a bar. Would I work? And you're going to be working with them for a decade, so you better like them. Pros and cons of convertible notes at pre-seed stage. I would say pre-seed, it's almost always convertible notes. Seed, it's kind of a mix between the two. For investors, you're going to get more governance with a priced equity round, but most convertible notes are, most pre-seed rounds are convertible notes.
Can you?
I have a private. Go ahead.
Can you comment a little bit on the trends in startups? Which sectors are getting ramped up and which ones are starting to, or ramp down or whatever? What are the trends?
Yeah. So the obvious ones would be ed tech, telemedicine, or digital health. I think those are really trending upwards. One sector I particularly like is future of work. So future of work kind of breaks into two areas. One is serving the non-traditional worker, which all of us have been for the last year and a half. And then the other is worker automation. And so future of work is really interesting. And I think the last, obviously, year and a half has really accelerated that. Logistics tech is very hot right now because I think we're all realizing just how important data around supply chain and transparency around supply chain is. I'm trying to think of less obvious areas that are doing really well. I think that e-commerce and direct-to-consumer is trending down. I do feel like those are kind of saturated.
How about virtual reality areas?
Yeah, so virtual reality and kind of augmented reality, I would separate into three layers. There's kind of the like hardware layer, there's the development layer, there's the application layer. I personally am a believer in the middle development layer. I think the hardware layer as an angel investor, it's very hard to invest in that. Very capital intensive. They're gonna have to raise lots of rounds. And also from a hardware perspective, who wins is often based off of like regulatory changes and like weird corporate dynamics more so than like the best software. Applications are very hard to invest in because how do you find the best AR game or so I really like the development and the enablement layer, and I think that's a very interesting space to invest in, and definitely one that we look for.
What do you call a development and enabler?
So if you have like an Oculus headset and you have a game that lets you see whatever, the game is the application, the headset is obviously the hardware. It's what makes it easier for game developers to develop games where things spin, like is a very simple example, but it's like that layer that makes it easier for people to develop the cool content stuff that we're all using, and that would be the development enablement layer.
Angela, when you call a deal bad and run away?
Wait, where do I'm sorry?
When you call a deal bad, when you know that's going nowhere and then you call it quits?
So as an investor, if like a company is doing poorly, the reality is I don't really have any choice but to stay with them until the end. But we help them, right? Like we try to help them find customers or investors, whatever the case may be. And then I think it's knowing how to be helpful in an efficient way, because I don't like to turn my back on founders. And so we try to be helpful, but then I have also helped founders say, look, it's time to liquidate, or it's time to do an acqui-hire. And so I've had to have some really tough conversations, and I think founders appreciate that because we are all aware of sunk cost fallacy, and founders are really, really privy to that. And so I think helping them take a step back and be like, is this really worth 4 more years of your life? You know what, maybe it's time for us to pull the plug. And so I've had to have some really difficult conversations. And I've had a lot of difficult firing conversations. I think people, it's hard to fire, especially if someone helped to build the company with you. And it's also really hard when the company starts to have middle management, because sometimes the person who was your CTO, when it's a 10-person company, is not the person who should be your CTO when it's a 50-person company. And that person has to get layered. It's a very difficult kind of inflection growth point. So we've had to have some difficult conversations there too.
Again, if you have a question, please submit through the chat.
So VCs have an investment thesis. should an angel build an investment thesis? I think you should build like a rubric of what matters to you. And it might be that I only want to invest in diverse teams, or I only want to invest in Brazilian companies, or I only want to invest in a company that at least has 6 months of customer data. So I would come up with like a checklist, less so than an investment thesis as an angel investor. And there's a private question, which is when startups are overly optimistic, what do you do? We just divide everything by 2 or 4. Honestly, any revenue projections they give us, we kind of just haircut them. And we don't penalize founders for being optimistic, because by definition, founders have to be optimistic.
Have you invested in other countries besides the United States, Angela?
Canada, yeah, we've invested in a few Canadian companies.
Sorry, Pedro.
Can you talk about some kind of a framework for analyzing competition in these early stage companies?
So I think the most important thing around analyzing competition is 2 things. Is one, to look at indirect competitors. So I think that founders often are like, here are the 3 other startups doing exactly what we're doing. Be more broad, right? So who is a substitute? Like, go back to like Porter's 5 forces, right? Who's a substitute? You know, what does that look like? And I think the best way to do that is to look at a market map. So if you just Google EdTech market map, FinTech market map, you'll get these like crazy charts. And then our job as an investor and as a founder is, is to help them to make sense of all of this, right? And to say, okay, out of this map, which ones are your competitors, indirect competitors, customers. So I think that's one, looking at a market map and really identifying indirect competitors. And the second is asking yourself the question, what is the problem you're solving? And then all of a sudden, your indirect competitive landscape gets really, really big, right? As opposed to just thinking about the other startups doing exactly what you're doing, because there are 1,000 ways to solve a problem. And if you approach it from problem solve versus product, you will get way more of an expansive competitive landscape.
I'm going to take advantage of this lull here. I want everybody to know we're a nonprofit organization, and everybody in the Colombia community, we would very much appreciate all of you volunteering and working with us. You'll find it very exciting. You will find lots of opportunities to learn new things. You get to make great people like Angela Lee, and you will have a fun time. So I want to make this appeal to everybody before we terminate the session. You will not get paid, but you will have a great time. Pedro, back to you as a host.
Thank you. I think we may have time for 2 more questions. And we have one here in the chat. What's an advice you would have for foreign companies on how to best approach American VCs? What cultural gaps, handicaps, and barriers have you noticed in working with foreign startups?
Yeah, so I'll start with the second part of it first, which is I have noticed consistently that non-American founders are less polished pitchers. I think America, like we just take those wild, generalizations about Americans being a little bit more cocky, having a little bit more hubris. I think that is true. And I think American investors are used to a very polished, high confidence pitch. So I do, when I'm working with, especially if English isn't their first language, I sometimes will actually, help them with like a pitch coach. We even have, like a diction coach to really like help with accent, all that kind of stuff. So that's one thing. And then the second thing is I find that a lot of times international founders, when they come to America, they just do like a scatter shot. They're like, I'm just going, like, I'm going to look at all American investors. Instead, I would be concentrated. I'd be like, okay, based off of maybe where my acquirers are or where maybe the hires are going to be, I'm going to focus on like Boston and LA, or I'm going to focus on San Francisco. And I would probably avoid San Francisco and New York. They're tough markets, they're huge markets. And so I might try to pick like a large second-sized city and to be a little bit more focused versus being like, I'll take a meeting in Des Moines, Iowa, and a meeting in Tallahassee, and a meeting in California, and just being a little bit more focused. That would be my advice.
So another question from one of our board members here, which is worried about the process. So am I. It's timing. is increasingly a challenge for angel groups as hot deals get too close around faster these days. You know, any recommendations, you know, process-wise?
Yeah, have a fast process, which I know isn't that helpful, but for, you know, so for 37 angels, from pitch to funding, we guarantee that we will give them a decision in 4 weeks. And I think you have to make some sort of promise to the founders of this is the timeline, and it means that you have to say no to your angels. So this literally, we just had an investment round close a week and a half ago, and one of my angels emailed me yesterday and was like, "Can I invest?" And I was like, "No, the window's closed." And it sucks to have to say that conversation, but I think you have to have a timeline and stick to it. It doesn't have to be 4 weeks; it can be 6 weeks or 8 weeks. I wouldn't go beyond 8 weeks, but it is a founder's market right now. And so as investors, we actually have to sell ourselves to have access to these deals. And a great way to do that is by being efficient and say no quickly. A lot of the times we know it's a no, but we say maybe, or we like hem and we haw. Tell them no and let them go meet and talk to other investors.
How much value is continuing this? How much value do these startups give to mentorship, smart money, etc., which people talk a lot about?
So I think that the value of your network is very important. Introductions to investors, introductions to acquirers, introductions to hires. I think that's incredibly important. I think that smart money in the sense of subject matter expertise, the founders don't care about. And to be fair, like they should be the subject matter experts, right? So if I think about what we consistently get asked for, we always get asked for introductions. We don't get a lot of like, what do you like? We're investing in a genomic sequencing company. Like they're not coming to us around like genomic sequencing best practices. It's much more on introductions. And that's where a group like this, given the size of the network, the depth of your Rolodex is, I think that's where we can bring a lot of value.
Well, thank you very much. We really
You're welcome. I'm
appreciate you
sorry I
being
talked
here.
so quickly, but I was like, there's so much I have to say.
We don't have enough of you. You can talk faster even, we'll still listen to you. There's enough, there's plenty of information. We're all learning a lot. You know, I want to thank you very much from my side for participating. And we hope to be in touch more often to
I would
get
love
some
that.
of,
I would love an excuse to visit again. I've never eaten so well than when I was in Sao Paulo.
oh, good. And then we would like to show you in a few, you know, next time we meet up, what we have done in the Angels Network here and what has been happening. But we do have one of the largest alumni groups of any foreign university. We got over, you know, we have alumni here, about 1,200 alumni in Brazil. A lot of them from the business school, a great part of them from the business school, and all of them in very successful in their careers. So hopefully we will be able to do your networking effect, as you said, and all that.
I would love that.
Thank you again. Thank you very much.
Of course, thank you.
Thank you, Angela. Some
Thank
last
you,
comment
Angela.
here.
Thank you, Professor Lee, and thank you, Pedro and Harry, for organizing this amazing event. It was certainly a plethora of information that will be very helpful. We're very lucky and thankful to have been able to talk to you before we have our first pitch night. And we're very excited to put this to good use. Thank you so much for being with us, and we're looking forward to seeing you in person here in Sao Paulo.
Cheers.
Cheers.
Thank you very much.
Cheers to everyone. Good night.
Good night.